For decades, Toshiba stood as a symbol of Japanese engineering, a diversified group spanning consumer electronics, energy-related systems, infrastructure, and technology. The brand carried a sense of reliability, careful manufacturing, long-term projects, and deep relationships with customers and suppliers. Yet inside large, complex organizations, the most visible success can sometimes hide the hardest management reality. How difficult it is to keep every division performing consistently year after year. In the years leading up to the accounting scandal, Toshiba faced a business environment that demanded steady results even as global competition intensified. Big infrastructure and technology projects often have long timelines, uncertain costs, and shifting customer requirements. Profits are not simply earned at checkout the way they might be in retail. They're often recognized over time based on estimates about how much work has been completed and what the final cost will be. This makes management judgment and oversight especially important. A central part of the later investigation focused on how certain long-term projects were accounted for, including the percentage of completion method used to recognize revenue and profit as a project progresses. This method is widely used in industries like construction, engineering, and large-scale systems delivery, and it can be appropriate, but it relies on accurate forecasting. The company must estimate total costs, total revenue, and progress toward completion. If estimates become overly optimistic or are not corrected quickly when conditions change, reported profit can drift away from reality. What makes Toshiba's story educational is that it was not just about technical accounting. It was also about how goals, culture, and hierarchy shape decisions. Investigative reporting described an environment where teams felt strong pressure to meet profit targets, and where unrealistic expectations from leadership could influence how results were presented. When performance targets become the main message, people can start treating the numbers as something to manage rather than something to measure. In July 2015, an independent investigation concluded that Toshiba had overstated operating profit by 151.8 billion yen over several years. That figure mattered not only for its size, but for what it implied. The problem wasn't a single mistake. It reflected repeated misstatements that accumulated across time and business units, suggesting that internal checks were not catching issues early enough. To understand why such situations can persist, it helps to picture the scale of decision-making in a large conglomerate. Each division runs its own projects, negotiates its own contracts, and forecasts its own costs. Senior management depends on layers of reporting. If the organization does not encourage early reporting of bad news, like cost overruns or project delays, then estimates can remain optimistic for too long. When those estimates flow into accounting results, the official story can become smoother than reality. This is also where governance and internal controls become more than formalities. Controls are meant to create friction against wishful thinking. Good systems require documentation, independent review, and consistent adjustments when new information arrives. If controls are weak, or if the culture discourages honest escalation, the organization can gradually normalize small misstatements until they become a pattern. Toshiba's reputation made the turning point even more painful. When a trusted name is linked to misstatements, stakeholders don't just question one year's results, they question how the organization makes decisions. Investors may wonder whether future forecasts can be relied upon. Employees may feel uncertain about stability. Business partners may hesitate, even if daily operations continue. This first chapter of the story is therefore about context, a respected company, complex long-term accounting, and a performance environment that rewarded meeting targets. These ingredients do not guarantee a scandal, but they do raise the need for strong governance. In the next part, we'll follow how the problem came into focus publicly in 2015, what the independent committee reported, and why management accountability quickly became unavoidable. By mid-2015, Toshiba faced a moment that large companies dread: questions about whether reported profits accurately reflected business reality. When such doubts emerge, the most important word becomes credibility. Markets can accept volatility, they can accept restructuring. What they struggle to accept is uncertainty about whether the numbers are dependable. To address the situation, Toshiba established an independent investigation committee. The committee's report, released in July 2015, became the anchor document for understanding what happened. It identified widespread accounting irregularities and concluded that operating profit had been overstated by 151.8 billion yen over several years. The report's value was not only in the headline number, but in the patterns it described: multiple divisions, repeated decisions, and governance weaknesses that allowed misstatements to persist. One recurring theme was the relationship between long-term projects and accounting estimates. The percentage of completion method requires a disciplined cycle of re-estimation. As costs change, the company must revise forecasts and reflect those changes in profit recognition. When projects run into difficulties, the correct response is often to adjust assumptions promptly, even if doing so makes current results look worse. The investigation materials explain the general risks of this method and the importance of reasonable estimates. But accounting mechanics alone rarely explain a long-running problem. The more human issue is how organizations respond to stress. Investigative summaries and business analysis highlighted strong pressure to achieve targets, where employees felt compelled to align reported results with expectations. In environments like this, teams may delay recognizing bad news or interpret accounting judgments in ways that favor short-term appearances over long-term accuracy. Once the findings became public, leadership accountability moved fast. News coverage at the time described top executives stepping down, including the president and other senior figures, signaling a major leadership reset. Such resignations do not fix systems on their own, but they do change the tone. They tell stakeholders that the company is acknowledging the severity of the issue and that governance will not remain unchanged. The Tokyo market and regulators also watched closely. When a company's disclosures are found to contain significant misstatements, regulators typically focus on two questions: what was misstated, and why internal safeguards did not prevent it. In Japan, the Financial Services Agency, FSA, publicly addressed the matter in press conferences, reflecting the seriousness with which the issue was treated. A subtle but important point for viewers is that accounting scandals are rarely one bad quarter. They are often the result of repeated decisions that individually may have seemed manageable. A forecast wasn't updated. A cost increase wasn't fully recognized. A target was treated as non-negotiable. Over time, these choices can create a gap between reported performance and real performance. This is why independent investigations matter. They provide a structured narrative based on evidence, allowing the board, regulators, and investors to work from a shared set of facts. Without that, the conversation becomes rumor-driven and emotionally reactive, which tends to harm everyone involved. The 2015 investigation also created a blueprint for what Toshiba needed to do next: restate results where necessary, strengthen internal controls, rebuild oversight, and address cultural factors that discouraged early reporting of problems. The crisis forced a reset, not only in leadership, but in how the company had to think about integrity in reporting. In the next part, we'll look at the regulatory and auditing dimension, why auditors came under scrutiny, how oversight of audits changed after the scandal, and what this teaches about the limits of external assurance when internal culture is weak. When a major company's profits are found to be overstated, attention quickly turns to auditors. Many people assume an audit is a guarantee that everything is correct. In reality, audits are designed to provide reasonable assurance, not absolute certainty. Auditors test samples, review controls, and evaluate whether accounting judgments are supported. In complex businesses, auditors rely heavily on the integrity of internal reporting and the willingness of management to disclose problems. After Toshiba's scandal, Japan's Financial Services Agency took disciplinary action related to auditing. In December 2015, the FSA announced an administrative action against an audit firm and certain certified public accountants, stating they had attested to financial statements for specific fiscal years that contained material misstatements, as if they did not. This was a significant message. Auditors are not passive observers. They are expected to exercise professional skepticism, especially when management estimates and long-term project accounting are involved. This part of the story is not about making audits sound weak. It is about understanding how audits can fail to catch problems early if several conditions align: complex estimates, high organizational pressure, and insufficient challenge to management assumptions. If the culture inside a company discourages open discussion of cost overruns or project difficulties, the data auditors receive may not reflect the full picture. Even a well-designed audit approach can struggle if it does not reach the right information. Toshiba's investigation materials highlight the inherent risks of percentage of completion accounting, especially the need for reliable estimates of total costs and the progress of work. For auditors, this means the most important work often involves understanding the estimation process. Who creates cost forecasts, how often they are updated, what evidence supports progress measurements, and how the company responds when project conditions change. In other words, the quality of the process matters as much as the final numbers. The scandal also became a catalyst for broader reforms in audit oversight and corporate governance in Japan. Reuters reporting later described regulators working on new standards and approaches intended to improve audit quality and strengthen the profession's resilience against similar failures. This highlights a key theme. Large corporate failures often lead to system-level changes, not only company-level consequences. From an educational standpoint, this is a good moment to clarify what good governance looks like in practice. It is not only about having committees and policies. It is about ensuring that internal audit functions have independence, that finance teams can report issues without fear, and that the board receives unfiltered information. It also means building a culture where revising forecasts downward is treated as responsible management, not as personal failure. Another lesson is the danger of target certainty. When profit goals are communicated as fixed commitments rather than aspirations, teams may begin to search for ways to make results align with expectations. In healthy organizations, leaders leave room for reality. They ask for early mornings, they reward honest reporting, and they treat adjustments as part of disciplined management. The Toshiba case also shows how a company's structure can increase risk. A conglomerate with many divisions and global projects may struggle to maintain consistent control standards everywhere. Some business units may be more mature in project governance than others. Some may have stronger cost tracking systems. If group-level oversight does not identify weaker areas early, problems can concentrate where controls are least effective. As the audit and oversight conversation intensified, Toshiba also faced market consequences, reputation damage, delays in reporting, and heightened scrutiny from investors and regulators. The practical takeaway for viewers is that trust is not rebuilt through statements alone. It is rebuilt through repeatable systems, controls that are visible, tested, and improved. In the next part, we'll move from oversight to outcomes, penalties, market responses, and what Toshiba had to do to stabilize itself while restating results and reshaping governance. Once the investigation results were public, Toshiba entered a difficult phase that combines accountability with continuity. A company cannot pause its operations while it repairs its governance. It must keep serving customers, supporting employees, and fulfilling contracts, especially when it handles long-term infrastructure and technology projects that customers depend on. Regulatory consequences soon followed. Public statements and reporting indicated that Toshiba set aside funds in anticipation of administrative penalties connected to false statements in securities filings. Later commentary and analysis referenced the size of the monetary penalties paid in Japan, reflecting the seriousness with which disclosure misstatements were treated. For viewers, the point isn't the exact number alone. The point is what penalties represent. A formal conclusion that disclosures were not acceptable, and a financial cost that reinforces the value of truthful reporting. Penalties also have a signaling effect. They tell the market that oversight bodies are willing to act, which can help restore confidence in the system, even if it is painful for the company involved. At the same time, Toshiba faced another kind of cost, the cost of rework. When results are questioned, companies must review past financial statements, revise them where needed, and strengthen internal documentation. This is labor-intensive and emotionally draining work. It requires teams to revisit decisions and rebuild processes that should have been reliable from the start. There was also the reputational dimension. Toshiba was not a small or obscure company, it was a flagship name. When a flagship company faces disclosure problems, people naturally ask what this says about broader corporate governance standards. That attention can amplify the consequences because the company becomes a reference point in discussions about management culture and transparency. Stabilization requires a multi-layered response. Restatement and transparency. The company must provide corrected information and communicate clearly about what changed and why. This is the foundation of rebuilding credibility. Governance reform. Board structure, oversight processes, and internal reporting lines often need to be adjusted so that uncomfortable information reaches decision makers sooner. Control redesign. For project accounting, this can include stronger cost tracking, clearer rules for updating estimates, and tighter review of progress measurement. The goal is to reduce the chance that optimistic assumptions remain unchallenged. Cultural repair. This is the most difficult and the most important. Culture changes when leadership changes what it rewards. Accuracy, early escalation, and responsible risk reporting. An additional element that became visible after the scandal was increased scrutiny of auditing and the broader professional environment. When regulators take action related to audit work, it can influence how audits are conducted across the market, raising expectations for skepticism and review of management estimates. For Toshiba, the stabilization phase was also about protecting the core business. Many of its customers were enterprises and public sector entities that value reliability. Maintaining customer trust required consistent delivery and calm communication. Overly dramatic messaging would risk creating unnecessary anxiety. Understated messaging would risk appearing dismissive. The balance is difficult. Acknowledge the issue, describe concrete corrective actions, and keep operations steady. This chapter of the story is a reminder that accountability and continuity must coexist. A company can admit misstatements and still keep serving customers, but to do so sustainably, it must demonstrate, not merely claim, that its systems are stronger than before. In the next part, we'll look at the internal lessons Toshiba and many observers drew, how performance targets, hierarchy, and decision-making patterns created risk, and what practical reforms can prevent similar breakdowns in other organizations. The Toshiba scandal is often remembered for the headline finding, overstated profits across multiple years. But the deeper educational value was the why. Why did a long-running pattern form? Why did internal safeguards not correct it earlier? Why did estimates and reporting drift away from reality? A major theme discussed in many analyses is pressure. When leadership emphasizes specific profit targets as if they are promises, teams might start to view those targets as the primary requirement, even when conditions change. If a project faces cost increases or delays, the responsible action is to adjust forecasts promptly. But if the culture suggests that missing targets is unacceptable, teams may delay acknowledging problems or interpret assumptions too optimistically. Another theme is hierarchy. In strongly hierarchical environments, it can be hard to deliver bad news upward. People may fear that raising concerns will be seen as disloyal, negative, or incompetent. Over time, the organization can develop a habit of presenting only good updates until the gap becomes too large to ignore. This is not unique to Japan or to Toshiba. It is a universal risk in large institutions. The Independent Investigation Committee's work and the broader reporting around it pointed to management involvement and organizational dynamics, not merely technical errors. This matters because it shifts the lesson from don't make accounting mistakes to design systems and culture that make accurate reporting easier than optimistic reporting. In project-based businesses, the most sensitive area is estimation. Estimation involves judgment, and judgment is influenced by incentives. If project teams are evaluated primarily on short-term profit delivery, they may feel motivated to maintain optimistic cost estimates longer than they should. If they are evaluated on long-term project health, on-time delivery, customer satisfaction, and realistic risk reporting, they are more likely to update forecasts responsibly. This leads to a practical governance insight. Incentives are a control system. They are as powerful as any checklist. A company can write perfect policies, but if it rewards the wrong behavior, the policies will not protect it. A second practical insight is the value of independent challenge. Healthy organizations build constructive friction into decision-making. Finance teams challenge project assumptions. Internal audit tests the process. Committees review unusual trends. The board asks questions that management must answer with evidence, not optimism. Without this friction, a company can slide into comfortable narratives. A third insight is how complexity can hide issues. Toshiba's scale meant many moving parts. If each part makes small choices that improve the appearance of short-term performance, the combined effect can become large. This is why early detection matters. It is easier to correct a small misstatement quickly than to repair a multi-year credibility gap. After the scandal, Japan also intensified discussion around corporate governance and audit quality, reflecting recognition that prevention requires system-wide improvement. Reuters reporting described plans for stronger standards in the audit profession after Toshiba's case. Again, the educational point is not that one company's failure defines a whole market, but that high-profile cases often accelerate reform. For viewers, The most constructive conclusion from root cause analysis is that organizations must create safe pathways for truth. That means encouraging early escalation of problems, training managers to treat bad news as useful information, building consistent project governance frameworks, and ensuring leaders publicly reward accuracy, not just ambition. In the next and final part, we'll bring the story together: Toshiba's longer term changes, the wider impact on governance expectations, and the lasting lessons for any organization that wants growth without sacrificing credibility. After the immediate shock of the 2015 findings and leadership changes, Toshiba's longer challenge was straightforward to state but hard to execute: rebuild trust. Trust in markets is not restored by a single announcement. It returns through repeated cycles of accurate reporting, consistent governance, and visible improvements in internal discipline. The scandal's impact extended beyond Toshiba itself. It became part of broader discussions about corporate governance and the quality of audits, especially in environments where hierarchy can shape communication. Public reporting described how regulators and market participants considered reforms intended to strengthen audit oversight after Toshiba's case. The presence of these reforms shows that major cases can change expectations for everyone, not just the company at the center. Within Toshiba, rebuilding required a focus on three pillars. 1. Governance structure that invites challenge. Boards and committees must not only exist, they must function as real centers of oversight. That means independent directors with authority, transparent reporting lines, and regular review of high-risk accounting areas, especially long-term project estimates. 2. Controls designed for project reality. Long-term projects evolve, costs change, schedules shift. Good controls require frequent re-estimation based on evidence. They also require standardized rules for how progress is measured and how forecast changes flow into financial reporting. The investigation documents emphasize both the mechanics and the risks of percentage of completion accounting, reinforcing why disciplined estimates matter. 3. Cultural reinforcement. Culture becomes visible when teams feel safe sharing difficult information. Rebuilding culture means leaders consistently rewarding early warnings and realistic forecasts. It means training managers to ask, "What do we know now that we didn't know before?" And have we adjusted our expectations accordingly? Another lasting lesson is about reputation. Toshiba's name carried decades of goodwill, yet the scandal showed how quickly credibility can weaken when disclosures are questioned. In a public company context, credibility is a form of capital. When it declines, everything becomes more expensive: financing, partnerships, recruiting, and even customer confidence. For investors and the general public, Toshiba's case also offers a clear framework for evaluating other companies. If a company depends heavily on estimates, ask how often those estimates are revised and who challenges them. If targets are presented as non negotiable, ask whether leadership also rewards transparency when targets cannot be met. If internal audits are rarely discussed, ask whether the organization invests in prevention, not just reporting. Most importantly, Toshiba's story reminds us that ethical reporting is not only a legal requirement, it is a practical business discipline. Accurate numbers are how a large organization coordinates reality across thousands of decisions. When the numbers drift from reality, the organization's ability to make good decisions declines, often long before outsiders notice. In the end, this case is not only a cautionary tale, it is also a guide to stronger management. Build systems that surface truth early, set targets that respect uncertainty, and create a culture where accuracy is treated as a shared responsibility. That is how companies protect not just their reputation, but their ability to operate confidently for the long term.